I have a question from a client that just came in. It looks like they're moving to another state or thinking about moving to another state. They want to know what should they consider tax-wise before moving to a no income tax state? What should they look forward to?
Yeah, no income tax states are. I like them generally. Tennessee, Alaska, Washington, Florida, Texas. I think I'm missing one or two there. Oh, New Hampshire just went tax free.
Oh, wow.
Yeah, it was New Hampshire. Mississippi is going tax free, but in 10 years or something. It's some weird plan that they came up with. So, yeah, so there are considerations. So, one is in the year of your move, you're going to be a part year resident in one state and a part year resident in the other state. And you got to make sure that the withholdings for the different states are correct. So, it like California is a great example of this. California is very aggressive. Like if you move out of California, but you're still receiving money from California, you're still going to be paying California tax on it. Um, if you move from California to Florida or California to Texas, but you keep the same job and now you're just working remote, you're still paying California tax. And there's other states that have similar kinds of arrangements. Usually, if you're in two states, your home state will give you a credit for the tax you pay in the other state, and that'll reduce your home state tax. So if you're in New York and Connecticut or something like that. However, if you're in a tax-free state, there are no taxes on the other side, and so that home state will take the whole thing. So that's something to be aware of. Some people get caught by that and are surprised. I thought I was here. Yeah, but your source is wherever it's coming from. If you're getting a new job and that new job is in the new place without taxes, then that's fine. Then you don't have that same issue. There are some states will directly apportion your income. So, okay, I earn $5,000 in this state, and I earn $10,000 in that state, and I just pay tax based on whatever those numbers are. Other states will do a percentage of gross income. So it might be that the state you don't live in has $5,000 of income, and your overall income total is 25,000. So then they'll say, okay, 5 out of your 25 is going to be from our state, and therefore we're going to assess you a tax based on that percentage. But what happens when you have adjustments to that income that actually lower your home state tax? So what happens in this kind of, if you have investment real estate like we were talking about, and that creates a negative on your taxable income, that negative reduces your total income, which increases the percentage of that other state's comparison to the whole. So you actually get taxed more in that other state. And again, every state is different. And so there are several different approaches that states have taken over the years. And so you have to make sure that you are aware of whatever one you're dealing with in the state you are moving from. Also, the state you're moving to, unless it's one of those tax-free states. Yeah, it can get complicated. Moving expenses for most people are not deductible anymore federally, but some states they are. So California kept their moving expense deductions. Most states follow the federal, though. There's individual differences like that. 2106 expenses. So this is one of those things that was wiped out by Tax Cut and Jobs Act, but California kept theirs. So for state purposes, you can have certain deductions that aren't allowed federally, and you should just be aware of the states that you're involved with and how that's all working out. So in short, it depends. But by and large, if you're moving to a tax-free state, that's generally going to be better monetary-wise when all said and done. There are other costs, though. So, like property taxes. So, like Texas is becoming famous for this, where it's like, yeah, we don't have any state income tax, but our property taxes are high and our sales taxes are high. Florida, property taxes are reasonable-ish. Insurance is very high. Sales taxes are middle high-ish. So, how each state handles, because every state government is going to raise revenue in some fashion. And it's just, is it coming through income taxes? Is it coming through property taxes? Is it coming through sales taxes? You're going to be paying the piper one way or another. And you want to look at that total tax load when it comes to all those different things in terms of how it affects your particular situation. And go into it with eyes open, knowing that, so that you're not blindsided by, I thought this was a tax-free state, but I got to pay 20 grand a year in property taxes. They're getting some amount of money somehow, and whether the per capita amount that you would be responsible for comes from pocket A or pocket B, does it really matter? I don't know. I actually would prefer income tax over property tax because there's more you can do to affect income tax than you can to affect property taxes. So there are
That's
people who
actually,
make, yeah,
I
there
see
are
that.
people who make a hobby out of protesting property taxes. It's your results are tend to be limited. So yeah, just things to be aware of when you're moving states.
Yeah, so for my next question, boss, is what is the tax smart way to support aging parents financially?
Ooh, um, that's a tough one. So there are all different kinds of situations. Most elderly people are gonna end up with some kind of taxable income. And some people, sometimes mom moves into the in-law suite and becomes a real dependent. But that's relatively rare these days. That used to be much more common. And so the what it comes down to is the fact that, especially as people age, they're going to need more and more help with their situation as far as managing their finances. And that's true of taxes. It's true of everything else. There's telephone scam calls and all kinds of stuff that you have to be mindful of as parents age. But one of those things is taxes. So I have a number of clients who are coming into the office, and it's a 94-year-old woman and her 60-year-old son, or whatever it is, and he's helping her just manage all the stuff because faculties are kind of there, not, and she can sign stuff and she understands what's going on, but keeping track of all these different numbers is tough. So really just being there for them and helping them manage all that is really the key element. There can be times when it makes sense to have different arrangements if they go into managed care. That's a whole separate thing. But even then, had a client this year who went into managed care, passed away, but still had like giant amounts of retirement income. We had still had to file their own final tax returns and everything. In those cases, there's a special thing with managed care where a portion of your rent is typically counted as medical expense, um, but that's case by case. It's hard to give generalities there beyond just being involved and making sure that money's being saved and not. I can tell you stories. I had one guy come in. This was years ago. Comes in. His wife passed away, and they were not super old, but like 60, 70, something like that. He brings in his stuff, and he's getting all these weird notices in the mail, all these amounts due from stuff from the bank and all this kind of stuff. And as it turned out, that his wife, who had passed away, was a huge gambling addict and had kept it hidden for however many years. But then she passed away, and all the notices that had been coming that she'd been intercepting, he was now getting, and he had no idea about any of this. Whether it's that or whether I've had retired people come to me and say, I'm going to invest all my life savings into the Iraqi dinar because it's going to make me $1 billion or whatever. And I was like, okay, I'm not your financial advisor, but that sounds dumb. So there are a lot of people out there who prey on the elderly with all these different scams and everything. So make sure that you're there to prevent all the money from being spent frivolously, because there are real world consequences. Because let's say your mom or whatever is getting on in years and she has a pension from whenever she worked and she makes whatever. She between Social Security and her pension, she makes 60 grand a year in retirement. And if she then takes that $60,000 and sends it to scammer X, you still owe the tax on the 60,000, right? That's a problem. So there's not so much there's less to do with strategy. There are some things you can do, but again, very dependent on circumstances. But by and large, the biggest thing to do is just be involved, make sure that things are being taken care of, make sure taxes are being filed, make sure paperwork's not being lost. All these kinds of things is really what comes into play when it comes to the elderly. So that's my it depends for that one.
Yeah, and I totally agree with that, Neil, because my aunt stays with my mother, and literally $349 every month she was giving over to these scammers. We didn't know about it. She was doing it for 5 years. Can you imagine that?
Yep.
So, couldn't believe it, but yeah, I agree. Totally agree here. So we have a tax planning and wealth building question.